Hey everyone, welcome back to our channel, your go-to spot for understanding money, investing, and building a smarter financial future. Today, we're diving into one of the biggest financial commitments most people ever make, mortgages. We'll break down what they are, how they work, the different types, what affects your payments, and how to make smarter decisions when it's time to borrow for your dream home. By the end of this video, you'll understand mortgage fundamentals like a pro will, so let's jump right in. Section 1. What is a mortgage? A mortgage is basically a loan you use to buy real estate, usually a home. It's a legal agreement between you, the borrower, and a lender, typically a bank or credit union. You borrow money to buy the property, and you promise to pay it back over time, with interest. The property itself acts as collateral, which means if you don't pay, the lender can take possession through a process called foreclosure. Mortgages make homeownership possible for millions of people because very few can afford to buy a home outright in cash. Section 2. How a mortgage works. Now, let's talk about how mortgages actually work. Most mortgages are paid off in regular monthly payments over a set term, commonly 15, 20, or 30 years. Each payment includes two parts. 1. Principal, the amount you borrowed. 2. Interest, the cost of borrowing that money. At the start, most of your payment goes toward interest. Over time, more goes toward paying down the principal. That's called amortization. Section 3. Key mortgage terms. To understand mortgages, you'll need to know a few key terms. Down payment, the cash you pay upfront, typically 5% to 20% of the home's price. Loan term, the length of time to pay back the loan. Interest rate, the percentage charged annually for borrowing money. April annual percentage rate includes both the interest rate and lender fees, a more complete measure of cost. Escrow, a separate account where part of your payment goes to cover property taxes and insurance. Private mortgage insurance (PMI), insurance you may have to pay if your down payment is less than 20%. It protects the lender, not you. These terms pop up constantly in the mortgage world, and understanding them gives you the upper hand. Section 4. Types of mortgages. Next up, let's look at the most common types of mortgages. 1. Fixed-rate mortgage. The interest rate stays the same for the entire loan term. Your monthly payments are predictable, great for budgeting. 2. Adjustable-rate mortgage ARM. These start with a low introductory rate that changes over time based on the market. They can be risky if rates rise, but may save you money early on. 3. FHA loan. Backed by the Federal Housing Administration, great for first-time buyers. Lower credit score and down payment requirements. 4. VA loan, for eligible veterans, active service members, or spouses, no down payment required in many cases. 5. Jumbo loan, for expensive properties that exceed conforming loan limits, usually higher rates and stricter requirements. Each has pros and cons depending on your financial goals, credit, and how long you plan to stay in the home. Section 5. Factors that affect your mortgage rate. So, how do lenders decide your rate? Here are the big ones. 1. Credit score. Higher scores equals lower rates. 2. Down payment. More money upfront equals less risk for the lender. 3. Debt-to-income ratio (DTI). Lenders prefer you spend less than 43% of your income on debt. 4. Loan type and term. Shorter loans usually have lower rates. 5. Economic conditions. Rates rise or fall with inflation and central bank policy. Even a small change in rate, let's say 6% versus 7%, can mean tens of thousands of dollars over the life of the loan. Section 6. Understanding your payment. When you make a mortgage payment, it's not just principal and interest. It often includes taxes and insurance too. Visual, payment breakdown pie chart. Principal and interest, property taxes. Homeowner's insurance, PMI if applicable. This total amount is called PITI: principal, interest, taxes, and insurance. Lenders look at your PITI to determine how much house you can afford. Section 7. How to shop for a mortgage. Now, let's talk strategy. Don't just take the first offer. 1. Compare lenders, banks, credit unions, and online options. 2. Get pre-approved. It shows sellers you're serious. 3. Compare APRs, not just rates. 4. Watch out for hidden fees and closing costs. 5. Ask about early payment penalties. Even a 0% to 5% better rate can save you thousands over the life of your loan. So shop smart. To recap, a mortgage is simply a loan secured by your home. Understand the type of mortgage, your terms, and how rates work before signing anything. The more informed you are, the better deal you can get, and the less stress you'll have later. If you found this helpful, hit that like button, subscribe for more financial tips, and drop a comment below. What part of the mortgage process do you find most confusing? Thanks for watching, and I'll see you in the next one.